Then another amendment to IAS 1 is about how to recognize liabilities in the financial statement, in the statement of financial position. You know, in the statement of financial positions, liabilities can be current or non-current. Now, how do we determine if a liability is a current liability or non-current liability? Under the existing IAS 1, companies classify liability as current when they do not have an unconditional right to defer settlement for at least 12 months after the reporting date. But this has been removed by the amendment. So now we are not going to be classifying liability as current just because we don't have that unconditional right. Now the rule is that a right to defer settlement must exist at the reporting date and have substance. A right to defer settlement must exist at the reporting date and have substance. So if we want to classify a liability as current, we just ask ourselves, okay, do we have an unconditional right to defer it? If we don't have an unconditional right to defer it in the next 12 months, then that means that we classify it as a current liability. But if we have an unconditional right to defer it above 12 months, then it will be a non-current liability. Now, what we are saying here with the amendment is that that right to defer must exist at the reporting date and must have a substance. So it is not left with just judgment. It's not just left with assumptions. It must exist at the reporting date and it must have a substance. Now, let me give you an example of this. Especially some of these things will be liabilities with covenants. You know, there are certain liabilities that a company will have, and the liabilities will come with a covenant. So let me give you an example of what we are talking about here, especially when there is loan with covenants. How do we decide whether this loan should be accounted for as a current liability or a non-current liability on the face of the statement of financial position? And this is an example from the publication made by KPMG. So I'm going to be sharing that with you here. You're going to see that on your screen as well. A company has a loan that is payable in 5 years. The loan includes a covenant requiring a working capital ratio of at least 1.2 on 31st December 2024 and 1.5 on 30th June 2025. The loan becomes repayable on demand if the ratio is not met on any of the specified covenant testing dates. The company is preparing its annual financial statement for the year ending 31st December 2024. The working capital ratio at 31st December 2024 is 1.3, and the company expects the ratio to be 1.4 at 30th June 2024. So let's do the analysis. At the reporting date, the working capital should be at least 1.2. So when they tested in the December 2024, the impact on the classification is yes, because the company complies with the covenant at the reporting date, it will classify the loan as what? Non-current. Future covenant. Working capital of at least 1.5, and that is also in the 30th June 2025. No. Covenant that the company must comply with after the reporting date do not affect the classification of the loan at the reporting date. However, new disclosures will apply. So if at the reporting date we are breaking the terms and conditions attached to the loan, then the loan is likely to be called to be paid. Hence, although it's a non-current liability, although it's not due to be paid, we would have to classify it as a what? Current liability if we don't meet the criteria at the reporting date. But if it is something in the future, like in this example, you must have your working capital ratio at the rate of 1.5 on 30th June 2025, which is after the reporting date. That will not affect the recognition of the item or the classification of the item on the face of the statement of financial position. And so that is what you need to understand about this. And again, we would get into this in detail when we are doing the IFRS masterclass. But that is what you need to understand, that when we are classifying liabilities as current or non-current, especially liabilities with conversion options or liabilities with covenants, we would have to look at the reporting date. There has to be that right to defer at the reporting date, and that rights must have a substance. Then and only then can we classify it as current liabilities or non-current liabilities.